overdone in general, overdone in certain instances? And does that mean that you don't believe that there are going to be further distressed institutions surfacing?
Thank you, Mike. I would say that when you look at past periods of time where there's been panic selling in bank stocks like we're seeing this week, if you take the longer view, 12 months, let's say, on average, following the 08-09 bottoming as well as the 2020 bottoming, bank stocks are up about 88%. So whether the bottoming is literally today or next week, it's around this time, because we will stem the nervousness and the angst that everybody's feeling today with bank stocks, because the deposit outflows will stabilize and the system will, I think, start to stabilize later next week and into the end of the first quarter.
You point out this morning that in previous cycles, when you did have fears around the banking system and you got a bottom on a monthly basis in the stocks, that they rallied massively afterward, right? So it would be 2009, back in 2000, 2002. However, they were a lot cheaper, the stocks were, in those instances, right? So the largest banks right now have not necessarily gotten to those valuations relative to book value, tangible book value, that would necessarily suggest that they're completely washed out.
No, that's a very fair point, because when we put this current situation on a scale of 1 to 10 versus those other periods, I think we'd all agree that at the early days of the pandemic in March of 2020, when we really didn't know what the final outcome was going to be, and of course in the financial crisis in 08-09, you put that on a 1 to 10 scale, those being 10, the worst possible scenario. The current situation we're in is probably a 5, maybe a 6. So that's why, to your point, and it's a good one, that prices just haven't fallen as much, but nor should they have, because we just don't have the same issues that we had in those other two time periods.
But Gerard, what about the longer-term earnings power of some of these banks? If the cost of funds is going up, if the regulatory burden, for example, increases, let's say they all have to now mark to market their held-to-maturity portfolio, are you taking that into account, and what impact will that have?
No, you're absolutely right that there's going to be lower profitability. We pointed that out in the report this morning that we expect banks, right now, the largest banks, as you may know, have to adhere to LCR, liquidity coverage ratio, which means they have to hold on their balance sheet 30 days worth of cash or very liquid securities to handle a bank run. Well, those are the biggest banks. We expect banks between the asset sizes of 50 to 250 will be held to higher levels of liquidity. They'll be probably forced to take their AOCI, the unrealized losses in their securities portfolio, through regulatory capital. And I think you're right. We are going to see lower profitability, just like we saw after the 2008 and 9 financial crisis, that we saw a reduction of 200 to 300 basis points in ROE. This one, it's hard to say exactly how much, but it's fair to say 50, maybe 100 basis points of lower profitability measured by ROE. But the stocks, I think, are just overdone, even with the expectation of lower profitability in the future.